New data out this morning showing the number of Americans filing for unemployment dropped to a near 49-year low. That's, in fact, the biggest beat this year. So with all this recession talk, is it just overinflated, what I call professional pessimism? Well, joining me now, three of the best professionals out there. Lindsey Bell, a CFRA First Trust Advisors Chief Economist. Brian Wesbury is with us as well. And a Chief Investment Strategist for Janney, Montgomery, Scott. Mark Luschini is joining us as well. Lindsey, let me start with you because I know you've been a mix, right? You've been cautiously optimistic, right, but there's some emphasis on the caution part.
Yes, exactly. My biggest concern, I've been saying this for a while, is really the trade issue. Now we have 90 days, all right, until we come to maybe a conclusion of the negotiations with the U.S. and China. And look, we're optimistic. We think that both of these presidents want to come to an agreement in an orderly fashion. But in the meantime, businesses have all of this uncertainty and this environment that they have to operate in, which is going to prevent them from spending on capital investments and hiring. And you've seen that in the numbers. That's where my concern lies.
Brian, I call you Mr. Sunshine. Help me out here.
They do call me Mr. Sunshine. And I don't see this evidence of corporations slowing down. In fact, what's interesting is global trade, when you add up exports and imports, has never been higher than it is today. And whenever you have a correction in the market, Charles, I think we all know this, everybody looks for a reason. And it seems like, at least in the last 9 or 10 years, every one of those reasons always ends up with the end of the world, another recession, another 2008. And I don't see anything like that on the horizon. The Fed's not close to being tight. Corporations are making record levels of profits. They have record assets. Real investment is, I think, how you need to look at it, is at an all-time record high. And profits are going to continue to grow. And so this economy, I don't think, faces a recession in the next 2 years for sure. I don't know about 2021, but you can't see out that far anyway. Well, but at least in the next 2 years.
Mark, a new survey out this week, about half of the CFOs that were surveyed see a recession next year. 82% see a recession in 2020. Now, I know CFOs are paid to worry like that, whereas the CEO is generally the chief excitement officer. So where do you see us going?
Well, Charles, probably not all that dissimilar to the other guests. I don't think it's a 2019 phenomenon. I mean, that would require a massive deceleration from the kind of growth we have. And I think there's tremendous momentum behind the growth that we're experiencing at the moment. I mean, just in the last week, we got 2 ISM readings on manufacturing and services that corresponds to a nominal GDP growth rate around 6%. And we know we're operating at a well above trend pace of growth. And while our view is likely that we're going to see a slowdown by way of 2019 over 2018, even then, it's likely to operate at an above trend level. So all the kind of substance around what we think is likely to continue to push this economy forward in a positive fashion, we believe, from employment to wage growth to confidence levels, will remain largely intact, and therefore view this as perhaps a second half 2020 phenomenon. Maybe 2021, as Brian said, gets a little fuzzier the farther out you go, but it's clearly, in our view, not a 2019 event.
The bottom line is it is ultimately going to happen, but we're more concerned about the nearer term. It is interesting because the economic data, as everyone's pointing out, very robust. But then you get data, Lindsey, from the markets. Well, there was this sort of toying with the inverted yield curve, the action in the market itself, financials. I mean, a huge red flag. What's going on there? And if the financials are this weak and this vulnerable, what does it say for the economy? You could say the same thing about industrials and materials. So there are different signals out there beyond the robust data we get on the economy that suggests otherwise.
Yeah, the financials, you usually need them to lead the way to keep the market going higher, as well as the tech sector. But the financials are a concern. And the biggest concern there really has been the yield curve. Rates were going up. That was so exciting, a year ago or 2 years ago. That was supposed to drive these banks higher. Well, we're finally in an environment where the Fed hiked 4 times this year, or is going to hike 4 times this year with next week's hike. And that you would have thought would be good for the banks. But as the yield curve compresses, where higher rates come to meet lower rates, it's harder for the banks to make money. And if they can't make money, loans aren't flying off the shelves. It's a problem for the banks.
Brian, do you see what's your biggest worry, Brian?
Yeah, well, first of all, let's go back to these banks and the bond market for a second. you know, everybody acts like the bond market is some kind of all-knowing entity, like it's never wrong, and the stock market is always wrong. But the bond market has made huge mistakes in the past. If you go back to 1971, the 10-year yield was like 5.3%. The next 10 years inflation was 8.9. It was a huge loser to buy bonds in 1971. And I think these bond yields it's the one bubble I see in the marketplace. And when we do talk about banks, they're making record levels of earnings. They've never earned more money. They're flowing rivers of cash. And on a forward earnings basis, the whole S&P 500 right now is trading at 14.9 on forward earnings.
Which is significantly below the 5-year average, right? I mean, we never had a crash.
It's a correction.
Right. We never had a market crash at 14 PE for sure. I just want to get Mark in here for his final thoughts real quick. So Mark, what gets us out of this malaise then? When do we sort of get a calm amongst the professional warriors?
Well, I think we have to see a couple of things. Obviously, I think this next meeting for the Federal Reserve is going to be a delicate one with regard to not so much whether they raise interest rates, which seem likely, but rather what is their dot plot forecast for the attention to further interest rate increases out over the balance of 2019. The other, of course, is trade. Any resolution around that would go a long way toward reducing the uncertainty associated with that. But the other signal I'm looking at is global growth and seeing any kind of arresting of the deceleration in those global PMI readings that have been falling now since they peaked last December, would suggest to me that perhaps we can start to see a resumption of non-U.S. economic activity occurring in a positive fashion, which would take some of the relief off of investors that are worried that we're going to basically import it here in the United States and succumb to the same recessionary conditions a lot of countries outside the United States are experiencing. It has
felt like our moat has been getting smaller and smaller. We're getting wrapped, but Lindsey, the last word to you real quick. You wanted to say something.
No, I agree with the last guest. I think those are all the things that we need to be resolved.
All right. Well, we have a checklist. Hey, 3 of the best minds on the economy. I think you hashed it all out for us, and we appreciate it. Lindsey, Brian, and Mark.